It is just the latest move in the increasingly bitter trade war between the U.S. and China.
In developing news tonight, Beijing has responded to Donald Trump's apparent U-turn in their escalating trade war.
When China stopped taking deliveries of Boeing aircraft, the shock wasn't just felt in Seattle, it echoed across the globe. This wasn't just a canceled contract, it was a retaliatory strike in a long, simmering economic war. Fueled by years of mounting tariffs, political friction, and power plays, China's recent decision to halt Boeing deliveries has potentially put more than $150 billion in future deals at risk and put a target on one of America's most iconic companies. Let's break down how we got here, what it means for the aviation industry, and why this crisis may reshape the future of U.S.-China trade. It all began during Donald Trump's presidency. Determined to rebalance the trade deficit with China, Trump launched a series of escalating tariffs, first on steel and aluminum, then on billions in electronics, agriculture, and industrial parts. China responded with its own tariffs. Back-and-forth duties turned into a tit-for-tat standoff. For a while, civil aviation stayed out of the conflict, but that changed dramatically in 2025. In a direct counter to renewed Trump-era tariff threats, Beijing instructed its airlines to halt all new Boeing deliveries and suspend purchases of U.S.-made aircraft parts. Boeing is America's largest aircraft manufacturer and one of its biggest exporters. The company has a global backlog of around 4,500 jets, and over 1,200 of those orders were tied to Chinese airlines or leasing companies. That's 26 to 28% of Boeing's global order book. The numbers are staggering. A single wide-body jet can go for $300 million. Even conservative estimates suggest that China contributes $10 to $12 billion in annual revenue to Boeing's bottom line. Add maintenance contracts, spare parts, and services. That figure could exceed $150 billion over the next decade. Cutting off that stream isn't just painful, it's existential. The market reacted fast. Within days of the announcement, Boeing's stock fell by nearly 10%, wiping out $20 billion in market value. But that's just surface damage. Thousands of smaller suppliers, building engines, landing gear, avionics, and cabin interiors are also at risk. If the supply chain slows or halts, analysts estimate up to 10,000 jobs could be lost by the end of 2025. Boeing itself employs over 140,000 people, with more than 30,000 in commercial jet manufacturing alone. Every 1% drop in delivery margins can ripple into layoffs across the country, from South Carolina to Kansas. Why Boeing? The answer is leverage. Boeing is not just a manufacturer, it's a symbol of American engineering dominance. Targeting Boeing strikes both economic and psychological pressure points. Meanwhile, China has been investing heavily in its COMAC program, promoting the C919 as a homegrown alternative to the 737 MAX, and its deepening ties with Airbus. Reports suggest China may soon announce a new Airbus deal worth over $20 billion. Switching isn't easy. Replacing Boeing planes means retraining pilots, upgrading maintenance systems, and enduring months-long transitions. Still, Beijing appears ready to bear short-term costs in exchange for long-term independence, and to remind the U.S. that it holds cards of its own. The broader economic impact is enormous. U.S. civil aviation exports sit at around $130 to $140 billion per year, with China accounting for 15 to 18% of that market. That's roughly $20 billion annually. Take that away, you don't just hurt Boeing, you damage the U.S. trade balance and industrial base. Aerospace jobs touch nearly every U.S. state, and the sector is a key buffer against the current account deficit. What's worse, Boeing was expected to sell 500-plus new planes to China over the next 10 years. The potential value? Between $150 to $160 billion. If Beijing diverts even half of those to Airbus or COMAC, Boeing's future earnings could be slashed by $50 billion or more. In Trump's recent speeches, he doubled down on tariffs, insisting that China had has manipulated currency, stolen technology, and hurt American workers. His trade advisors argue that tough love is necessary to correct imbalances, but critics say Boeing is collateral damage in a geopolitical gamble. Inside Congress, opinions are split. Some lawmakers are urging tariff flexibility to protect Boeing. Others believe it's time for the U.S. to decouple strategically. Either way, Boeing finds itself caught in the middle, used as a pawn in a high-stakes economic war. Europe's Airbus is the unintentional winner here. If China follows through with its rumored orders, Airbus could capture an additional 15 to 20% market share in Asia. That would cement its lead in the global narrow-body aircraft market and deepen Boeing's decline. Meanwhile, COMAC's production isn't yet mature. The C919 still faces global certification hurdles, and wide-body alternatives like the CR929 are years away from commercial use. But if China throws its full weight behind COMAC and sidelines Boeing, the long-term shift could be irreversible. The Boeing crisis could be just the beginning. China's state media has hinted at broader retaliatory steps. Other U.S. exports, like soybeans, semiconductors, and liquefied natural gas, might be next. Analysts warn that a second wave of tariff retaliation could trigger global supply chain shocks. With interest rates high and global debt mounting, a full-scale trade breakdown could tip the world into recession. This isn't just a fight over planes. It's a battle over markets, influence, and power. Boeing's share price may recover, new deals may be made, but the damage, strategic, economic, and diplomatic, is already deep. The U.S.-China aviation rift is now a case study in modern economic warfare. In targeting Boeing, China has shown it's willing to bleed if it means Washington bleeds more. For Boeing, the road ahead is rough. For global trade, even rougher.